additional sell-off as well. Rajesh Kothari is now with us of AlfAccurate Advisors. Rajesh, good to have you with us here as always. Thank you very much for your time.
Hi.
Just before you came, Rajesh, this news came again. For the nth time, I think, Trump is going to impose pharma tariffs. Pharma tariffs are coming soon. But, but whenever I've asked all these conferences, we had the Morgan conference, BofA, and the global analysts were here. And I remember asking all of them whether the sectoral tariffs are coming, and all of them actually said yes, because they are under a different section or whatever. So, they are going to be imposed on a variety of things, and pharma is one of them. Any thoughts on the space, Rajesh?
See, basically, you are absolutely right. So when you think from the US perspective, from president perspective, he is comparing the US pricing of the products compared to the patented products in the Europe region, be it Germany, be it France, or any other country. And there's a huge gap in this, correct? Because the pricing in US, that products are significantly higher than the same products in the European markets. And therefore, this entire concept of tariff. So, tariff is not on the generics or only keeping in mind India. It is more to do with the global countries in which these similar products are available to their citizens. And that's where this tariff is going to come to make sure there is a level playing field. Coming to India specific, we are more into generics market, correct? And here there is significant amount of, I would say, capacity consolidation has happened over last 5-10 years. Because the competition was intense and there was a huge pricing pressure. So there is no significant capacity addition by any major countries. In fact, if you look at the number of sites, they've actually reduced in last 10 years. So I'm not too much worried about as far as Indian pharma companies goes in terms of our generic pricing, in the US market. So let's assume hypothetically, there is about, say, 10% price increase from the Indian company's perspective. Surely it will not be 100% will be absorbed by Indian company. It might be one third. Like if you speak with any of the textile company in India, they also say the similar thing. 1/3 is to be borne by the consumer. 1/3 is to be borne by the US player, the particular manufacturer, the brand, and 1/3 might be absorbed by the Indian companies. Now, of this 1/3 which is to be consumed by the Indian companies, that is basically roughly about, say, 200-300 bips kind of impact on the US business. To offset that, of course, there are again levers to be used. Can there be some product mix changes? Possible. Can there be cost reduction programs? Possible. Can there be more kind of raw material related cost benefits? Possible. So net impact is not going to be significant. There will be some impact surely. Maybe 2-3% plus minus EPS is possible. But I don't see a significant major damage to the Indian pharma companies because of this Trump tariff.
Hi, Rajesh. Good afternoon. Good to see you in. It's been a while since we spoke.
Hi.
Rajesh, I wanted to ask you about another theme. That's the tech pack. If we plot the distance of various indices away from its recent high, well, the tech pack is still a distance away. That's because of the uncertainty on Trump. The argument that maybe in the next year or so, the growth is going to be still very anemic as well. And valuations are not particularly cheap to some part of the street. But that index has been actually the best performer in the last 4-5 trading sessions. Even today, it's doing quite well. How are you all placed on tech and what do you like?
Well, I think you have summarized it well, that, this entire tech pack is, first of all, it is a more linked to the US economy growth. It means you need to predict the US inflation. It means you need to predict the US BFSI and non-BFSI total technology spend. And of course, that picture is right now not much brighter. Now, there is a hope that second half is going to be better compared to what we are seeing in first half. But increasingly, even this second half is not going to be so bright spot. It is going to be from probably, poor, it will go to average. It is not going to be good. There is a hope that FY27 is going to be good. So there are a lot of, I would say, assumptions which are getting built in. Having said that, for Indian IT companies, the valuations, people look at from the dividend yield perspective, the free cash flow yield perspective, because they throw huge cash flow. And therefore, that acts as a downside support. So I would say it is going to be very, very narrow band. If you ask my personal view, we are not too much excited. We are a little bit underweight on this theme. Not too underweight because of that. Some valuation cushion is always there. And as and when US enters into the printing cycle again, or interest rate reversal cycle again, that's where the US economy growth will bounce back. And that's where IT spend will also to a certain extent bounce back. But if you look at the last 10 years, the top mega companies, IT companies growth, be it a earnings growth or be it a revenue growth or be it a market cap kind of thing, it's around 10-12%. So these are like 10-12% stories as far as large cap goes. So we are focusing a little bit on the tier 2 players where there is a more visibility. They are working more on AI, they are working more on cloud, the new technologies, and there is some M&A which has already happened in the last 2-3 years. And therefore, those companies probably can grow at 15, 17, 18%, which is definitely much better than 10, 11% growth, what the top 2-3 companies offers. So nothing to be too much excited about. Yes, I understand last 4 days they are performing, because you must remember that before that they underperformed, because before that there was something else which outperformed. So this weekly performance keep changing, but nothing much to I would say to get bull about it as on now basis. We'll keep reviewing.
Again, as you were coming on, Rajesh, we just got the news that CG Power has got an order, transformer order. That's a space that you've been very bullish on. I mean, I think Hitachi has been one of your top ideas there, and it's done very, very well. I think there was a note on, again, in the industrial space, Schneider from one of the brokers this morning, something we've been highlighting. Anything new there, or holding on to the same set of names which have done well?
I think nothing much new to talk about. I think this entire space looks quite exciting. It is a much more, I would say, 4 or 5 year thematic in terms of the tailwinds which are going to support you. So you look at in this market, what you need is you can't predict this Israel, Iran, and all that stuff, and Donald Trump daily Twitter. Very difficult to position your portfolio on these tweets. But what is more important, therefore, you increasingly look for that your short term, medium term, and long term, 1 year, 3 and 5 year, the theme should be in your favor. The tailwind should be in your favor, because you cannot swim against it. Am I right? And therefore, this entire space, particularly renewable energy, the transformer related space, the HVDC technology related space, a metro capital expenditure related space, this entire EMS space. So these are the very few, I would say, sweet pockets where the tailwinds are going to support you. The growth is going to support you. Of course, there can be quarterly volatility, but otherwise the growth is going to support you. And that's where probably, at least we are positioned from the portfolio perspective. So capital goods is one thing which we like, and specialty chemical, which I've been saying from last 2-3 months, is another thing where we have increased. We are almost like 0% weightage a few quarters back, and from 0 we are back to 9-10% in last 2 quarters or so. So these are the 3 C's what we like. Capital goods, chemicals, and consumer discretionary. So these are the three C's. What we like from the portfolio perspective.
You added Swiggy lately, right, Rajesh?
We would not like to disclose, but yes, you are right. We added Swiggy. It's a very small weightage. It's not a huge weight.
Okay.
And the primary reason, because we believe that one of the competitor in quick commerce, unlisted player, is probably getting more discipline over the next 12 months. And if that happens, then clearly, the profitability will improve, which is the biggest, most important thing to track for in such business models. And if profitability improves, the yield improves, and if that improves, the entire, your numbers will change over the next 2-3 years. So, that's the reason we added this name in our portfolio.
Okay, all right. Thanks a lot, Rajesh, for joining in and filling us in with your take on the individual sectors as well as on the market themes. Well, by the way, before we slip into a short break,